Shout out to our sponsors today.
Yes, thank you.
Sponsors and speakers.
That's got to be the smoothest it's ever gone.
Well, thanks for inviting us to participate in your event this year. I was going to kick it off with a joke, but my 8th grade humor would probably only appeal to Peter and Brennan, so I asked AI to give me some jokes relating to public sector risk managers and brokers. And there weren't that many good ones, but the one that I thought was kind of resonated with me was that a public sector risk manager and a broker go to a meeting together. One has a policy coverage question, the other one has a 42-page deck titled Market Update. And so pretty ironic that's actually what we're talking about. I counted our pages, and if you exclude the title pages, we're at 39. So. Real quick, for those of you that don't know Gallagher, I think most of you do, just public sector is our second largest practice group within our company. So we write $2.7 billion in premium just in the public sector. So a lot of the data we're going to talk about today is based on our internal databases. So just to give you that background, our particular team places over $100 million in premium volume. Today we're going to talk about Joe. I was going to do a quick historical market overview. Joe's going to talk about kind of where we're at in the various insurance cycles. Then we're going to talk about kind of where we've been 2025, 2024 timeframe, and then talk about where we're headed.
So historically, and we've shown this for several years now, but the market moves in cycles, right? So you move from a soft market to a hard market, and if we're starting in a soft marketplace, you have capital coming into the market. As capital comes in, carriers start to drop rates and they chase business. And eventually you get losses, they're going to catch up with the carriers dropping their rates. That's when you shift over into a harder marketplace. And then carriers raise rates strongly, they continue to chase losses, and eventually, hopefully, you find that profitability and you cycle back over to a softer market. So in a very simplified version, that's the cycles, and then every line of coverage is at a different point in the market cycle at any given time, and they move through these cycles at different speeds as well. So like 4 years ago, the property market was extremely hard. We saw it move out of that cycle pretty quickly after the rate adjustments, and now we're in a market with property where they're chasing rate and they're getting competitive. Same thing with cyber. Back in 2020 and 21, cyber, we saw the strong increase in rates, and now it's a very competitive market. Now on the flip side, casualty has been stuck on the hard market side for quite a while now because they continue to raise rates, but the losses continue to increase as well, so they haven't reached that profitability yet. And then this is another way to look at the market cycles. This is all lines of coverage, and it kind of just shows us over the years it ebbs and flows. What's interesting though is you have pretty substantial peaks and valleys in the market cycles as you go from hard to soft. But where we're at right now is we're in a pretty sustained hard market since about 2019. And it's been in a sustained hard market. We're trying to inch our way back down there, but we think casualty is kind of holding us up from going and transitioning into a soft market overall.
So transitioning to where we've been, this is a 5-year snapshot. It's hard. I know it's hard for you guys to see that, of Gallagher data for our public sector book of business. And when you look at this, this is rate changes by line of coverage. At high level, 3 things jump out at me. First, you see kind of this sharp fin, this grain line up here, which is the cyber market, which kind of hit a crescendo. During COVID 2001, we saw substantial rate increases. This, on average, the rate increase we saw in the public sector market is about 60%. If we overlaid Gallagher's entire book of business, that number was 40%. So public sector got hit the hardest when it came to cyber. least amount of controls were in place. It was just, it was the low-hanging fruit, so that we're seeing more losses. The second thing that jumps out to me is this blue line, and that's the property market. So Q1 of 2023-ish, right around here, that was right after Hurricane Ian. And then we saw the reset for the reinsurance market, and we saw substantially high property rates. And as you can see, that trend has started to been coming down ever since. And the third thing that jumps out to me is that, as Joe pointed out in the market cycles, this is a 5-year snapshot. This is zero. And as you go back over 5 years, everything is above zero, right? So we've been in this pretty sustained hard market, as Joe just talked about, for quite a while. This data ends as of the end of 2025. We see some downturn below the zero line with property, but the leaders right now on the top are excess casualty, followed by auto. The green line is actually GL. And so where we're seeing the best performance is then property, cyber, and then workers' comp is behind that. So talking about where we've been on property, this is a snapshot of billion-dollar losses that took place in 2024. I want to talk about 2024 before we talk about 2025. We had $9 billion plus weather-related events that were tied to severe convective storm in 2024. Then we had 5 named storm hurricanes as well in that year. A pretty substantial loss year, $140 billion in losses in 2024. The next slide shows the activity for 2025. We went from 140 billion to 107 billion in total losses. So we saw the market correct by about $33 billion. What was interesting is that really we had about, I think it was 5 severe convective storms that were over $1 billion. The severe convective storm dollar amount was 50 billion, but the LA fires accounted for $40 billion in losses in 2025. So if you took those fires out, we would have had a really great cat year in the 2025 calendar year. And then this is just a snapshot of where we're seeing a lot of the loss activity. And if you look at 2024, most of the losses were coming out of the Southeast, the Midwest, and Florida. 2025 was really driven by Texas and California, so we saw kind of a spread between those 2 years. And then this is just a snapshot that shows across the world, where the insured loss is coming from. And this blue bar here is the United States. Obviously, we're the most developed country in the world. We've got the most insurable exposure. We have the largest amount of losses. But as you can see, this reflects the frequency line. So the frequency of catastrophes is really somewhat flat, but the severity has been trending upward. And this section here is the LA wildfires from 2025. So if you took that out, again, 2025 would have been a really stellar year. This slide gives a snapshot over the last 20 years of counties across the country that have experienced 1.5 inches in diameter of hail or greater. And it also shows us that those same counties that have experienced this have seen a 36% increase in housing. So what we're seeing is that we're not seeing an increase in frequency of storms. We're just seeing an increase in severity. A lot of that is driven by density of properties and density of cities and towns. If you look, in Texas, Dallas, Houston, you look at Denver, you look at Nashville, Atlanta, those are all growing markets that have seen a lot of wind hail increases in exposure. And a lot of this in the Midwest, you've got older, especially on the residential side, you have older properties, older roofs, a lot more deferred maintenance that is coming into play as well. So severe convective storm is definitely is really not driven by frequency but severity. This just gives a snapshot of where the largest severe convective storms that we've seen over the last 10, the largest severe convective storms are top 10. Of the top 10, 6 of those have happened in the last 10 years, and 2 of those, consecutive 23 and 24, were over $50 billion. So again, it just shows that rising severity of losses for this class, this category. And this is a snapshot of our public sector rates. And this goes back for about, maybe 1, 2, 3,
2 years.
yeah, it's about 2 years. So in total, for our public sector class of business, if we look at Q4 2025, on the high side, at the 75th percentile, we were seeing almost a 2% rate increase. On the low side, we were seeing about a 14% increase. So kind of a spread there of about 10, the standard deviation about 10, 11%. But it's a tale of two product structures or markets. So if we go to the next slide, we've got the standard carrier property market. So that's going to be in Colorado. It's going to be a Travelers. It's going to be a Liberty Mutual. It's going to be an FM Global or an AFM. Those are kind of the main ones. Chubb. But there's not as many carriers riding that class of business. But what we've seen is that the rate change at the end of the year for the single carrier markets was much more. It's much less. It's about a 5% spread. From basically at 75 percentile, a 2% increase to about a 3% decrease. But if we go to the next slide, when we had the hard market, the single carrier market really was dried up, and we had to place a lot more business in the shared and layered market, the E&S marketplace. That's what this reflects. So that's where all the capacity went. So we really saw that market take off with a lot higher rates. And so we're also seeing that market now coming down faster with rate decreases. So at the 75th percentile for the shared and layered market, we're seeing -12 to -27%. So if you have a shared and layered program, you should be seeing pretty decent decreases in your premiums this year, unless you've had some pretty adverse loss activity.
And one thing on these rate charts too is we're going to show a lot of them. This is public sector specific data as well. So looking at casualty and where we've been with casualty, really I want to start with kind of the growth in the E&S marketplace. And it started back in 2019 and really started with property. But the E&S marketplace is really used as a safety valve for those risks that don't fit the standard marketplace. Then we take them to the E&S market, and there's supposed to be more underwriting flexibility, and we're able to place the risks there. That started with property in the hard property market. A lot of the property went to the E&S marketplace. It grew that marketplace. Property's gotten a little bit better, but now what we've seen is a lot of casualty business has gone to the E&S marketplace over the past 3-4 years. And really, since 2019, the premium written in the E&S market has more than doubled. So it's grown quite a bit because of how selective the standard market has gotten and how challenging some of these risks have gotten. So what's driving casualty? Again, we've showed this one before, but it's social inflation. So what social inflation is, it's when economic inflation is being outpaced by the growth in claim severity. So claim severity is that green line, which is kind of hard to see, but you can see the one that's spiking on the graph is the green line. And economic inflation is relatively flat. And so those gaps between economic inflation and claim severity is when we experience periods of social inflation. We've had periods in the past, in the early 2000s and the late 1980s, of social inflation. But what's different about those periods to where we are now is, first, they were driven by tort reform. And they also experienced a pretty sharp increase in the claim severity, and then it came back down and it leveled off pretty quickly, right? Right now, we're in a period of sustained social inflation, and it's driven by non-economic damages in jury awards, as we all know. So what this is here, this is just zooming in on that period of sustained social inflation that was at the end of that graph. And so we can see it's slowly gotten larger and larger and larger, the disconnect between the growth in economic inflation and claim severity. What's driving this? Nuclear verdicts, right? We all know what nuclear verdicts are. We all know nuclear verdicts grew. It used to be any verdict over $10 million. It was a nuclear verdict. And then they were becoming so large, they had to create a new term, thermonuclear verdicts. So we'll see what the next term is. But what's interesting is, since about 2009, the frequency of nuclear verdicts has increased 59%. The severity or the size of the nuclear verdicts increased 116%. And you can kind of see that here, and clearly we're trending up higher even more now. So this blue line, that's the mean. For those who are like me and are not math wizards, mean does not account for outliers in the data. So what's happening here is we have some extremely large nuclear verdicts that are pulling that blue line up. And clearly they were much larger than we've ever seen. But even if we account for the outliers, which is the median, this green line here, since 2020, nuclear verdicts have doubled in size. What's adding on to this is third-party litigation financing. It's a relatively new industry, and really what it is you have hedge funds or private investors coming in with a lot of capital, and they're investing in these cases to take them to trial to get a return on their investment. In some cases, they're getting 40, 50, 60% of the jury award. And really what's going on is we're getting more and more capital injected into this industry because they've seen such a good return on it. It's a very highly coordinated industry. For example, they're funding new science. They're going out and funding new science to support their cases because they found the jury favors recency. So they'll go fund that science so they can get the return on their investment. And I told this story, I think it was last year, but it's really interesting. So we were talking with Chubb, and Chubb was having a conversation with one of the lawyers who's involved in third-party litigation financing. And his question to him was, okay, so how do you pick your cases, right? And what does your margin look like? How many do you have to win, right? And the lawyer's comment was, if I have 10 cases, I only need to win one of those to make my investment back on all 10 cases and then some, right? So it's an industry that, first of all, thrives in the shadows. There's not much transparency in it, but they also market themselves as we're helping the little guy, we're helping the claimant, right? But they're not. They're in it for the return on their investment. They don't care about your case. They care about their entire portfolio of cases and getting their return. So if we look at the rates, this chart here, this is the primary rate, so that first layer of insurance over your deductible or your SIR. These are rate changes over the past 2 years. And this is a layer of insurance where carriers, they expect some claims, right? They expect some frequency in the layer, and they price to that. Their underwriting model expects some frequency. Even with their pricing, they haven't been able to keep up with the claims because we're seeing anywhere from 5 to 6% rate increases every single quarter. So they're continuing to have to chase those claims that they're seeing come in. And then once we get to the excess markets, this is a layer that historically it's a truly catastrophic layer, right? They're not expecting much frequency, if any, in that layer of claims. But now it's become a working layer with these nuclear verdicts. And so carriers continue to adjust their pricing models to try and get their arms around their layers becoming working layers in the high excess. So we're seeing on average about a 10% rate increase across the last 2 years. And what that tells me too is they're continuing to chase those claims, right? They can't just make that adjustment like they did with property and come back and regain profitability. Claims are continuing to increase, and so they're having to continue to push rate. We skipped to the last slide, bear with me. My computer doesn't like casualties.
These are really fast 39 slides.
Yeah.
We're efficient. Let's see, here we are. I jinxed us in the beginning.
Yeah. There we go.
There you are.
Let's try again. Okay, we're going to do this a different way.
I wonder if someone go into display mode.
I know.
And plug it back in.
We can always just go off the slide.
Yeah, we'll give it one more
That way if
shot.
we have to.
I have to go like that.
That'll work, yeah. So transitioning over to the auto coverage, I'm going to kick it off by just talking about auto physical damage cost drivers. We've seen a significant, since 2024, the cost of auto repairs really outpacing the CPI or Consumer Price Index. And that's being driven by really three things. The first one is just supply, is cost of parts has gone way up, supply chain. The availability of OEM products is hard to, it's become challenging. And then the labor force. Finding qualified technicians has become a real challenge in this space. See some of the claims people nodding their heads. We were in an Uber a couple months ago in Phoenix, and the driver was telling us how he had a friend in Colorado who was an auto body technician, and he was getting recruited to move to Phoenix, and they were going to pay for his housing and like almost doubling his compensation. It's just so competitive right now. So there's a real challenge there. And then the third component is just the technology, right? So if you look at a vehicle today, it's kind of a rolling network. We've got about, on average, 2,000 computer chips are in a car. It used to be you could repair something. Now you're replacing an entire piece instead of a component. That's really been driving a lot of the expenses associated with that. And so that's what's driving the higher cost of physical damage. And a couple other things that are driving cost is, and it's gotten better, but if you look at prosecutorial priorities, I'm going to use Colorado as an example. Prior to 2023, in our state, I'm sure you are all aware of this, but if a car theft was under $2,000, it was a misdemeanor, not a felony. We were the #1 state in the country for auto theft. After 2023, we passed a Senate bill that basically made all car theft a felony. Now we're 6th, so we're actually not as high. But part of that's just a function of the city. But that's one area that's driving obviously losses. The other thing that as we've been talking about weather, right? So when we're talking about all these tornadoes and convective storms, it's taking out vehicles. I know a lot of you have your property schedules or your autos are on your property schedules. And we've seen a lot of losses in that area. So those are a couple of things I think that are outside of what we already talked about. So this just shows the rate changes for our auto coverage. And so if you look at the end of 2025, at the 75th percentile, we were seeing 21% increases in auto in the public sector. At the 25th percentile, we're seeing 8.4%. The auto line of coverage has had 55 consecutive quarters of rate increases. For 13 years now, they have not made an underwriting, the industry has not made an underwriting profit on the auto line of coverage. So that's why we're seeing such a high, they can't keep up, as Joe was saying. We've also got the verdict component, all the casualty components that Joe just talked about baked into this line of coverage. With you guys, it's a little harder to see because a lot of you have package programs, or your GL and auto are bundled together in the same program. You don't quite see the auto exposure quite the same way.
Kind of looking at where we've been with cyber. So I think we all experienced it back in 2020 and 21. Cyber was a very hard market. What's interesting though is the volatility back in 2021, the volatility in the pricing. So that's when underwriters were placing a lot of scrutiny on controls, right? And if you had cyber claims, you were certainly way further up here. But let's say you had perfect controls, no cyber claims, there could have been a delta of about 60–70% in the price increase that you saw versus someone who might not have the best controls. So it was very volatile, and we saw the rate increases, and now what we're seeing is a very stabilized market with cyber. You can see all these lines have kind of come together. So your 75th percentile is maybe 10% away from your 25th percentile. So it's a very stable market now with cyber. And it has to do with a lot of things, but the first one would be carriers managing their loss ratio, right? So the loss ratio is basically how profitable the carrier is. The higher the loss ratio, the less profitability the carrier has. Once you get to around 60, 65%, it varies for every carrier. After you get over that, it's an unprofitable loss ratio for the carrier. But what we can see here, in 2020 and 21, they had much higher loss ratios. And if I go back to this slide, right at the end of 21 is when we saw the price increases. So carriers were reacting to their loss ratio, and it worked. Came back down, it leveled off for them for their profitability, and in turn, premiums followed. So this is looking at, what we added here is the green line is 25th percentile. Because it's real interesting, if you are a great risk for cyber, we're seeing a very, very competitive marketplace, even if you're not. Because if you can see the red line in the last 3 quarters, 75th percentile rate change and the median rate change are both at 0%. So even if you have a couple claims, the market's gotten so much more competitive where they're chasing market share, you're getting a 0% increase. We're working on a deal right now where our client, they don't have all the multi-factor authentication tools in place. There's a few pieces that are missing. 4 years ago, you're definitely getting a sublimit for ransomware coverage on your policy, right? We were able to get that carrier to quote it with full ransomware limits, even though they didn't have all their MFA in place. So carriers are going to have to be more flexible with underwriting as they continue to chase market share.
So looking at workers' comp, that continues to be one of the more stable lines of coverage. You can see really we're looking at anywhere between like a 2% increase at the 75th percentile to a 3% decrease. So it continues to be stable. Workers' comp has, we'll go to the next slide, Joe. Oh, no, let's go back to that one. A couple comments on workers' comp. 2024 end of the year at 86% combined ratio. So that means that, you know, underwriting profit plus that 14% left over. I mean, a really good year. They're projecting 2025 to be 85 to 93%. But we are now in the period where we've seen 8 consecutive years of combined ratio under 90%. So it's definitely been a super profitable line of coverage. One of the interesting stats on workers' comp is that 10 years ago, it made up 17% of the insurance in the insurance marketplace. Today, it makes up 10%. So that's I think it's a 41% decrease. A lot of that's driven by the fact that the market hasn't really grown. It's been profitable. It's been pretty stable. And then I think the other lines of coverage have just outpaced it. When we look at casualty, we look at excess liability, that kind of thing. So where we're headed on property, from a trend perspective, we've seen things settle down quite a bit from the Great Reset. You know, I'd say right now we're seeing trend rates, you know, from 1 to 4%, 2 to 5% range with most of our clients, and that's kind of what carriers are looking for as well. And for those of you that aren't familiar with that, that's just trending your property values up for inflation. The concrete and cement are probably the most expensive component. Lumber is pretty stable, and then steel is kind of the most variable cost component, just given the tariff situation. And then this just shows that we're in an improving marketplace. So these are shared rates through the second quarter of 2025, and then this is a single layer. But essentially, we're seeing this downward trend. We're seeing carriers fighting for market share. So that's the market we're in now in the property. Yeah, and from a developing trend perspective, we're seeing more capacity. We are seeing, we're seeing in the London market in particular, they call it a quote to bind ratio. London they participate mostly in these shared limit programs, and they put up low limits, like maybe 5 million or 10 million would be a big limit for them. But they'll quote, say they quote 5, that's their quote, but what they end up binding is something less. So like we will squeeze people out of a program because their rates are higher. So maybe they quoted 5 million, we're going to give them 2.5 million. So that's the quote to what they're actually binding. So we're seeing that start to happen. And then the other thing we're starting to see in the marketplace is if you're on a shared and layered program, we're able to have less participants in the program. We're getting more capacity from less carriers, which is nice. It just makes your program more efficient. Other things that we're seeing is we're seeing a lot more stability in the reinsurance market. When the reinsurance market was right-sized in 2023, a lot of carriers were forced to take much higher retentions on their balance sheet, which really pushes the losses higher up into the reinsurers, which has allowed them to provide much more favorable reinsurance terms. And then in the last, I would say the last 12 months, we've probably quoted more parametric coverage than I probably have in my whole career. And parametric is really a unique product that has a trigger tied to a specific thing that will pay out a dollar amount. And the whole idea of parametric coverage is it's supposed to mitigate severity and provide balance sheet smoothing. So an example would be if hail size in this particular area exceeds 2 inches and wind speeds in this area exceed a certain mile per hour, it's just going to pay out a dollar amount. You know, I've yet to sell one because I think it's really like, you know, it's really like finding a needle in a haystack. But for certain people, it's a good fit. It really depends on, you know, if you can't afford the budget volatility.
So where are we headed with casualty? By the way, Jeff and I are going to switch next year because I get the bad lines of coverage. So casualty, it continues to be a challenging line of coverage. We continue to see the number and the size of nuclear verdicts increase. You know, since 2020, we can see it's skyrocketed for nuclear verdicts. And so kind of just looking at what is the market right now for casualty? It's a very compressed marketplace for casualty. On the screen, this is the majority of the carriers that will write in Colorado, because we're not only dealing with the national issues of nuclear verdicts and law enforcement liability, we're also dealing with jurisdictional issues. Colorado is one of the worst states for law enforcement liability and sexual abuse and molestation coverage. So there's a lot of carriers on the chart here who have very selective appetite in Colorado. We've seen quite a few carriers pull out. But if we're looking by program structure, if you have a deductible, a small deductible, you know, $10,000, $50,000, whatever it may be, I can count on one hand the amount of carriers that would write that. Travelers, Liberty, Gladfelter, maybe a regional carrier like EMC, and of course the pools, right? That's it. And it's with Travelers and Liberty, it's a very onerous underwriting process because they're so close to the risk. You have such small risk appetite going with $50,000 or $10,000 deductible. So it's a very onerous underwriting process. And then once we get up, you know, the highest deductible we would see from these carriers would be maybe $150,000, probably closer to $100,000. The lowest self-insured retention that most carriers would offer once you transition to self-insurance, $500,000, probably more typically $750,000. So there's this big gap between the guaranteed cost market and self-insurance. There are some exceptions. The first one I would point out is Hudson. They run a program through Euclid where they will do smaller self-insured retentions. We've seen them quote anything from $50,000 SIRs with the goal, though, of getting that SIR up over time. So they're very flexible in the sense they'll work with you to help you transition to self-insurance if that's your goal, but they want to get that SIR up to closer to $200,000. And then the other one, who's been a market disruptor really for us, is Metis. So they're down in that ENS graph there. Metis they're a new entrant to our marketplace. They're not new to the market. They've been writing pools in Virginia for a while. But their expansion into the rest of the US is rather new. and they've been extremely competitive and really disrupted the marketplace and the rates that they're offering. And they're also, their minimum retention is $250,000. So what we're seeing with them is they're coming in and they're very competitive. And part of the reason we think they're able to be so competitive is because they don't have those legacy claims on their balance sheet, right? They have a pretty clean balance sheet. And so they're able to go into the market and quote very competitively. So we're paying attention to them and we're kind of seeing how their competitive quotes are going to play out for them in the next 3, 4, 5 years. But a lot of carriers here, again, not all of them have appetite for Colorado business, but this is really the market for us. Once we start getting into programs that are under stress with quite a few claims or retentions are being pushed up by carriers, then we've had to get creative, and that's where the reinsurance solutions comes in on the bottom there. So we've gone to the reinsurance markets to access new forms of capital to be able to fill some of this capacity and not have to settle for $3, $4, $5 million retentions that the carriers are pushing. We need alternative options. That's where reinsurance comes into play. One of the examples of how we've utilized this market is for those stressed programs where SIRs are being pushed up and maybe you're not seeing much of a premium relief from the SIR being pushed up. We've implemented this. This is a program out of London, structured financing program. Basically what you're doing is you're financing the retention increase. So what we've done is, say carrier wants you to go from $1 million to $1.5 million retention. We say, hey, no carrier, we're going to go from $1 million to $3 million. And then we're going to fund that gap with this. It's a 3-year deal. And what you can do is the majority, you pay premium, but the majority of that premium, it goes into an experience account, basically a loss fund, and you're funding your losses over time, and you're funding that gap in the increase in your retention. And the great thing about it is if you don't use those dollars because you have such good risk management, you get those claims back with investment income. So it's one of the solutions we've had to implement just to get creative because carriers, it's kind of their way or the highway right now. They're increasing retentions and there's not a lot of options. So if I look at developing trends, of course we're going to continue to see the issues of nuclear verdicts, strict underwriting around law enforcement, around correctional facilities, around abuse in schools. But what's interesting is this happened about 2 years ago with law enforcement. There are certain situations where you have to pull the law enforcement liability coverage out of the package program and place it on a standalone basis because of claims experience. Now we're seeing that with sexual abuse coverage in the schools. And then also the new excess capacity, so that's Metis. Seeing a little bit of a disruptor there with Metis. And again, we're watching how that works. But really what we're looking at is how tort reform is going to affect this industry. So tort reform is, we're getting started with tort reform to kind of combat the third-party litigation financing. There's been a few states that have implemented some reform, states like Arizona, Georgia, Florida has also implemented some. What they're mainly focused on with the legislation so far is disclosure around if third-party litigation financing is involved. So it's so new, we haven't seen those effects in the data yet, and to see how that tort reform is affecting the data, but we're keeping an eye on it, and more states are introducing legislation as well.
So developing trends on auto, I think we've kind of beat the social inflation, nuclear verdict thing to death, but that continues to be a challenge and continues to be a real challenge for our public sector clients because so many of you are taking large retentions, so it's a direct impact to your budgets. Continues to be a challenge though. We're also seeing a more of an uptick in third-party police pursuit claims where the client wasn't involved in an accident, but there was an accident with the person being pursued and their suits coming back against the public entity for negligence on that behalf. We just started to see a lot more of that than we had seen in the past. So I don't know if you guys are experiencing that firsthand, but that's one of the things that we're seeing as well. We're also seeing a shortage of, it's hard to find qualified drivers. So we're seeing some of our clients really probably not being as stringent on hiring requirements, or kind of bending the rules a little bit, or maybe not doing things to do as thorough of a background check on the driving. So that's become a trend as well. And then, when we look at the movement towards electrification of vehicles, vehicles now are 33% heavier. A lot of that's driven by batteries, which is driving a lot more severity of auto accidents. We also have the fire exposure, with lithium batteries. So those are some things that we're definitely looking at. I think a couple opportunities are just telematics and opportunities to implement some things. We're seeing a lot of that across the board, where how can we reduce frequency, provide a better defense using telematic solutions.
And then where we're going with cyber. So cyber, the threat landscape with cyber, it continues to change. And it continues to get more sophisticated, both on the bad actor side of things, but also on our side with the carriers and how we're defending our systems. It's interesting, there's now coordinated groups, whether they're nation state actors or independent groups, that are targeting cyber attacks. So now we have these coordinated groups on the bad actor side, and now carriers, you have a cyber policy with, let's say, travelers. You get access to a breach coach and a bunch of different resources. Now your carriers have sophisticated breach coaches who have specific experience working with XYZ group that they know about. So now you have an attack, let's say scattered spiders on the screen. Scattered spider, they identified scattered spider who attacked you. The carrier is going to say, okay, we have a breach coach who knows how to deal with them, and they're going to get them involved. So all the more importance to involve your carrier early and continue to keep the line of communication open and know their resources. With the increasingly complex groups for cyber attacks, we're still seeing the controls work. Knock on wood, but the controls are still working. So not the amount of claims frequency's up, but the number of ransoms being paid is down. And it's been down for 2 years in a row now. So it's interesting, these controls that were such a pain to implement and that all the carriers required, they work, and they're working still. However, AI. So AI is going to change this significantly as well, both on our side with how we defend our systems and how we use AI and implement it, also how the bad actors use it. I would be willing to guess the bad actors are much better than us at using AI. So it's going to be interesting how it continues to shift the marketplace. I would describe the current cyber market as competitive but fragile. Very fragile because of AI and what it's going to do to the marketplace. Even then, we see here, this is a graph just showing litigation related to AI. There was no litigation in 2020. Now we're seeing over 800 lawsuits for AI. So that's just a new risk popping up for us as well, right? How do we manage that risk, and how do we get through it? To add to that, the risk is growing even more with new legislation that's being introduced for how we govern our use with AI. So Colorado was actually the first state to sign a bill regulating AI. It's Senate Bill 24205. And basically what it was designed to do was to protect consumers against artificial intelligence discrimination. My immediate thought was, what does that mean? So basically what it means is if you are using AI to influence or make any sort of decision that's going to affect the consumer, the regulations in this bill apply to you. So like there's a whole laundry list of regulations, but a couple of them are you need to implement a risk management policy and framework around how you're using AI. Again, only if it's affecting the consumer though. affecting your decision, which is going to affect the consumer. You also need to disclose to the consumer that you used AI to make this decision that is affecting them. So we'll see. It gets signed into law on June 30th of this year, and we're keeping a close eye on it. And of course, some other states have kind of followed suit. So this is creating just another risk for us in the regulation space for how we're using AI. And then with cyber, I like to end with this slide because it really shows how we think this cyber market's going to evolve, change, and grow over the next multiple years. So what this is showing is reinsurance premiums written for both property and cyber, and then it's also giving us projections out to about 2036. So this is projecting that cyber reinsurance premiums are going to overtake property reinsurance premiums shortly after 2032. So it's a growing market, increasingly complex, and we're going to have to stay on top of it.
Yeah, workers' comp, 2025 saw a 6% reduction in frequency. So we're still seeing, good trends there. We're seeing some pressure on wage and medical inflation, which is probably going to push rate a little bit. And we're still seeing the shift towards demographics in the workforce continuing to get older. But we're also benefiting on the flip side still from remote working. I know a lot of people are back in the office on a hybrid basis, but we're still seeing less frequency as a result of that. And then the other piece is just spent a lot around mental health and a lot of legislation across the country. So that's an area where we continue to see things evolving in the workers' comp side. I know that's been in California for a long time. One thing I forgot to mention just on the property side is we predominantly have wind hail deductibles in Colorado that are percentage, right? But we're starting to see now with the market getting better, we're seeing in some areas some flat deductibles. They're big, but they're flat wind hail deductibles. So we're starting to see a little bit of a shift. Hopefully that'll continue. We have a client that has a $40 million wind hail loss, very substantial. And we're getting ready to do the renewal July 1, and they're indicating right now, the market is that they're going to do a flat rate renewal, which is crazy, right? That 3 or 4 years ago, they would have been non-renewing his clients. So it just kind of shows you where the property market's gone in a very short period of time. Do you guys have any questions for us? All right. Great. Well, thank you. We appreciate it.
Thank you.